Oh, it is April 8th, 2023. Let me start by saying I am not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. Today we'll be talking about stock symbol MMTLP, or what used to be stock symbol MMTLP, and the private company NextBridge Hydrocarbons. And we'll be talking about what I call reasonable price limits. Are they reasonable? Let's see. Anyway, before we start, I just wanted to say I saw this tweet from the SEC, and I thought it was important, and so I wanted to share it, and maybe we can watch this together and hear what the SEC has to say. Okay?
Give your money to a wolf in sheep's clothing?
Background check.
Before you invest, investor.gov.
That was an important message from the SEC, the Securities Exchange Commission. But unfortunately, I unknowingly gave my money to some market makers who naked shorted my MMTLP shares. They drove the price down from $12.50 all the way down to like $2.90. Some people might call that price manipulation, you know. But anyway, these naked short market makers, they were assisted by FINRA, who pulled this thing called a U3 halt, and that prevented short shares from ever being reconciled. Now, the actions of these manipulative market makers, they must have been condoned by the SEC. I'm thinking because I discovered there were thousands of complaints that were lodged with the SEC regarding manipulative short selling and FINRA's U3 halt of the MMTLP shares. I understand that FINRA reports to the SEC, but the SEC seems not to have done anything yet. I don't know. They disregarded everything. Anyway, I also understand that MMTLP investors, they even went to the SEC headquarters in Washington, D.C., so that the SEC might take notice. But again, the SEC had really no comment. Does that mean that the SEC and FINRA don't really care about protecting investors? It's been about 117 days, I don't know, or longer, I forget, since December 9th, 2022, when this happened, right? When the MMTLP NextBridge Hydrocarbon shareholders have been fleeced, essentially by FINRA and the short market makers. And the question is, were they helping out their short hedge fund buddies? I don't know. But at the time of this particular message from the SEC, it was April 5th, 2023. Let's go on. So what happened? What happened was that short hedge funds had about 6 months to close their short positions in MMTLP before there was going to be a spin out to a private company, and that private company was called NextBridge Hydrocarbons. Now, it's quite possible that FINRA may have conspired with them to keep that short position open and create a situation where now there's short positions in a private company. Now, before we go on, let's just recap. A short position means that a security is sold before it was ever purchased. The theory being that the seller intended to buy back the shares at some later time when the price is lower. So short sellers sell something they do not own. And that dilutes, when you sell something you don't have, that creates something called dilution, because it's a fake something, right? That dilution depresses share prices up until the shares are repurchased, right? So when I say over here that there are short positions now in a private company, this means that the private company shares essentially have been counterfeited. Think about that. Short positions in a private company, that means private companies' shares have been counterfeited. Now, FINRA happened to have released an FAQ, and they actually verified the existence of the short positions in this private company, NextBridge Hydrocarbons. Okay, we all know NextBridge Hydrocarbons does not publicly trade. So, FINRA says they had no choice. They had to do this because, settlement dates and whatnot. But here's what I think they should have done. They should have instructed broker-dealers of a corporate action that shorts must close their positions. And when you close a short position, you buy to close. By December 12th, 2022, they should have informed broker-dealers that, on December 9th to 12th, all trading for MMTLP has to be position close only. What does that mean? That means that longs, people who purchase shares, they can sell those shares to shorts. Now, shorts, those are people who have sold something they do not own. They can close their position by buying those shares prior to December 12th, 2022, okay? And that would reconcile all the shares, right? These are shares that have already been sold to buyers, okay? But unfortunately, those short shares have never been originally purchased. This would prevent those short shares from becoming fraudulent counterfeit shares. I don't know, maybe it's looking a lot like FINRA may have conspired with these short hedge funds to keep the short position open into the spin out of a private company, because they had a heads up warning of like 6 months, right? Now we know for a fact that there are short positions in a private company. And unfortunately, short positions, I would say, in a private company are equal to fraudulent counterfeit shares, okay? So, now, who is FINRA? We've been talking about FINRA a lot. FINRA is a self-regulatory agency. They've been empowered by Congress, and they report to the United States Securities Exchange Commission, the SEC. Now, their stated goal is to provide a resource for investors to feel confident about investing in U.S. financial markets. Somehow, it looks like they may be working with particular hedge funds to enable the counterfeiting of U.S. stocks and fleece investors, okay? Now, I think that the situation with FINRA's U3 halt and the resulting short position in the private company NextBridge Hydrocarbons, you know, it's gone on for 100 days without resolution. Don't forget, the short position in a private company is a fraudulent counterfeit share. It's a clear example, unfortunately, I think, of how corrupt U.S. markets are. FINRA's U3 halt, they basically fleeced 65,000 plus shareholders of the MMTLP shares, all to benefit a few short hedge funds and market makers. It looks like that's the case, you know. Until the situation is resolved, I'll have to say it's the clearest example of how corrupt U.S. markets can be. And this really harms the entire stock market. So I would really hope that FINRA works to try to resolve this situation, because it's you know, we don't want a corrupt market, do we? We want a fair market. That's all I have to say about that. Their releases, they were explosive smoking gun material. Since then, we've seen that 2 more members of Congress are interested, and they're asking for additional information. Ralph Norman's office, they've asked for the blue sheets that were spoken of in the FOIA emails. If you're not sure what a blue sheet is, you can freeze the video. Thanks to Gray Tendo over here, because he came up with this link to a great FAQ about what is a blue sheet. It's from Smart Capital Mind. Check it out. We also have info from Pete Sessions. He is asking George Pelicaris to provide some additional assistance in figuring out exactly what happened. This is the email, this is the letter, as we say. And Pete Sessions is from the Committee on Oversight and Accountability, and also on the Committee on Finance Services. So this is very, very relevant. So he wants to see what's going on with regard to, of course, the oversight of capital market activities and the data for potential reforms. They're starting to look at potential reforms in these markets. It's very relevant. It's very close. And things are moving. We have momentum. We also have James O'Keefe, who tweeted out about, hey, have you heard about the MMTLP scandal and what's going on there? This is a huge win. There are 1.3 million views on this one tweet alone. Most people won't know what's going on because they don't know what MMTLP is and all this, but it gets awareness going, right? 1.3 million views. I think it's up to us in the, who actually do have an idea of what's going on, to actually educate people on MMTLP, and just bring new people up to speed who are interested in exactly what's going on, because it's not obvious, right? And if you know what's going on, you might have to tell the story over and over and over again. You might even become sick of telling the story. Anyway, that's why I have videos, because I'm not good at telling the same story over and over again, but we'll see. I've had to do it a while. So on to the topic of the day, or the topic of this video, at least. We know that the question comes up: what's a reasonable number? And what's reasonable? I don't know. We do know that recently we've had some stuff happen at Silicon Valley Bank, where the bank was having some financial problems, and the president of the United States went up there on his podium and he said, Silicon Valley Bank deposits are guaranteed 100%. 100%. Any losses will be taken and shared from the entire U.S. banking industry, right? And why is that a big deal? Why is that a big deal? It's because all banks have this thing called FDIC insurance, right? It's a deposit, it's a depository insurance. But FDIC, as we know, the standard insurance is $250,000 per depositor per insured bank. Basically, that means if you have more than $250,000, you might not be insured. You're only guaranteed insurance up to $250,000. If you had $1 million, well, you're guaranteed $250,000 if the bank goes under. But the president has said he is going to make sure every single depositor is taken care of. Good move. I agree. I think that it is good to make sure every single depositor is taken care of. That is excellent. But how big is this? How much money are we talking about here? There's a reason that FDIC has limits on their deposit insurance, because, they may not have enough money, right? Who knows? Well, it turns out this particular mess with Silicon Valley Bank, Silicon Valley Bank had about $209 billion in total assets and $175 billion in deposits. So we know that taking care of a $175 billion problem is not a threat to the financial system. We've done it. It's okay. No problem, right? No problem. So for the U.S. government to deal with a situation that needs to be dealt with, to ensure integrity in the banking system, $175 billion is no problem. Easy peasy, right? Now, we're investors in the stock market, right? So as investors in the stock market, we're basically kind of like the depositors at Silicon Valley Bank. We bought and held shares of MMTLP in good faith. And how are we protected? What kind of insurance do we have? We have this thing called SIPC. SIPC protects against the loss of cash and securities, right? Now, SIPC is, every single broker has SIPC protection. The limits are basically $500,000 and $250,000 for cash, right? So we're protected for sure up to $250,000 in cash, up to $500,000 in security with SIPC. Now, a lot of brokers, like my brokers, Fidelity, they have greater than SIPC protection. They say, screw that. They say SIPC is not enough for our clients and our customers. We want to give them a better insurance, right? Because we want to be a better broker. So basically they say they have this thing called excess of SIPC coverage. According to Fidelity, the total aggregate excess of SIPC coverage available is about $1 billion. There's no per customer limit on the dollar value of securities, but there is a per customer limit of $1.9 million in cash. So what does that mean? Wait a minute, $1.9 million. Does that mean that if you have over $500,000 that SIPC would cover, if you have greater than 1.9 million plus the $500,000 that, you're not really covered in your brokerage account? Or, are you protected? Is your money safe at the brokerage account, right? I mean, who knows? Is it a good idea to pull your money out in case something bad happens? You might not have enough insurance. What's the deal here? Should you invest in something better like real estate? You can't, if you're invested in real estate and you got raw land, at least, the land will always be there. It won't, you can't burn land down to the ground. What do? Well, it turns out that within a single broker, you got SIPC and in excess of SIPC protection. This is what most people are aware of. But we have greater insurance capability than that. We are the U.S. government. We are citizens of the U.S. government. We live in the United States, which has, one of the greatest financial systems in the world. So to cover the entire market, we have this thing called the DTCC, the Depository Trust Clearing Corporation. There are some estimates that the backstop for the DTCC is something like $54 trillion. $54 trillion. I'm not going to go into the exact estimates because it varies based on how that goes. But if you get past the DTCC's insurance policies, right, you got the Federal Reserve. Now, the Federal Reserve has an unlimited insurance policy because they have the ability to print money. They can print as much money as needed by the situation, right? And we saw the Federal Reserve has acted when it was appropriate. So those are the two additional insurances that, you may or may not be aware of. So let's talk a little bit about the DTCC. What does the DTCC do, right? They are the Depository Trust and Clearing Corporation. They deal with settlement and clearance. What does that mean? That means that sellers of securities have to receive, the dollars, the cash from buyers, and that's part of settlement. And the buyers of securities have to receive the securities from sellers, right? So that's the second part, right? Everyone has to get what they want to get in that exchange. If they don't get what they're supposed to get, that's called an FTD, a failure to deliver. Now, failing settlement and clearance can result in FTDs. I'm not going to go into FTDs in detail right now. But if you fail to deliver the cash, you also trigger an FTD. It's not just being triggered by securities. If you fail to deliver the cash, you trigger an FTD. Okay. But wait, what happens if short sellers don't have enough money to buy this security, right? Well, suppose they don't have enough. Suppose the problem is so big that short sellers just don't have enough money to buy MMTLP or next bridge hydrocarbons from the longs because, people are saying the price might be too high. Is that possible? Well, the first question I have to ask is, who are the short sellers of MMTLP, right? How big of a position is MMTLP in their portfolio, right? And do they have enough money or credit to cover the purchase of MMTLP next bridge hydrocarbons? We have to ask, do they have enough credit available too? Because it's based on their portfolio, right? And what can the DTCs do if they don't, if they fail to meet this criteria, right? So who knows, right? These are the first questions you got to ask is, if you're worried about short sellers not having enough money to cover, you got to ask, who are they, right? So let's see. Who are they? Well, thanks to Nation Vibes. Thank you, Nation Vibes, for this tweet. He figured out who the short sellers were. In 2021, we have this list of short sellers. They include GTS, Canaccord, De Minimis, G1, right? Let's just pick one of them. Let's just pick GTS for the hell of it, okay? And let's see how much they have, right? So this is the GTS website. And let's see, are they proud? Do I think that they, are going to tell people all about their short position in MMTLP? Do we think they're proud of it? Do we think that we can find anything about MMTLP on their website, about that short position? So I looked really hard. And you know what? I couldn't find anything on their website about a short position in MMTLP, right? So do I think they're trying to hide this weird short position? Or, are they nefarious in trying to hide it? I don't really think so. Let's just give them the benefit of the doubt. Let's say that they're not going out of their way to hide their position in MMTLP, right? We know they have a short position. Let's say that they're not trying to hide their position, okay? But what do they say about themselves, right? What do they say about themselves and their assets on their website? What do they say? Well, it turns out one of the pages that they have, it talks about their portfolio, right? They say, our portfolio encompasses 1,116 stock issues with a market capitalization of $14 trillion. $14 trillion. And that's just in the New York Stock Exchange section, the New York Stock Exchange designated market making. That's just for them. They also have an ETF market making and a wholesale market making section. Geez, wow, they have that much. Or at least, their portfolio encompasses that much. So do I think MMTLP makes up 1% of their position? Well, if it did, that would be about $140 billion worth of MMTLP that they shorted between 2021 and 2022. $140 billion worth. I don't think they did that. So I'm guessing they probably don't have a 1% position, 1% short position in MMTLP. Okay. What about a 0.1%? That would be $14 billion of shorting. Somehow I don't think that they shorted $14 billion between 2021 and 2022, in these 2 years. I think it might be closer to 0.001%, maybe $140 million. I don't know. And that could be too high of an allocation. Don't forget there are other short sellers out there. GTS is not the only short seller. Okay. So maybe they shorted 140 million. I don't know. Who knows? I can't tell. But suppose for GTS that their short position went against them and it resulted in 100x losses just in the MMTLP short position, right? Well, it turns out that 100x losses would drive that 0.001% of their position all the way up to 0.1% of their assets, right? 0.1% of their actual portfolio. Yeah. Geez. Do we think that GTS might be able to get some credit or loan to cover that 0.1% of that portfolio that's giving them some problems? I don't know. I think that they might. Okay. Let's, so if GTS, if the short position in MMTLP is such a small portion of the portfolio, I think GTS can cover that either with the outstanding cash they have or something like that, or even if they have to get a loan, I'm sure someone can extend them capital to cover 0.1% of their portfolio, right? Let's look at the DTCC, right? I mentioned a while back that they have settlement and clearance. They have this particular article, it's called DTCC during market in turmoil. They're very proud of the fact that they help make markets secure in the United States, right? They even talk about what happened 20 years ago with the 9/11 terrorist attack. And they said, we cleared and settled $1.8 trillion of securities during the 9/11 terrorist attack. Cleared and settled $1.8 trillion. Okay. That was 20 years ago. 20 years ago. And the market's a lot bigger now. We've had inflation. God knows we have inflation. And you think the DTC might have some more money now in order to backstop in order to backstop any major problems? I think so. Okay. So let's take that $1.8 trillion that they had 20 years ago that they were able to use, right? And let's say that would cause problems in the market such that, that the DTC would have to get involved and so they'd have $1.8 trillion available, right? Now, we also know that a lot of people who are saying, MMTLP shareholders, you got to be reasonable. You might break the entire U.S., stock market by asking for too much dollars per share. Just be happy with about $20 per share. Okay, so let's see. What happens if $20 per share is what it takes to save the U.S. stock market, okay? With MMTLP. Let's say a settlement of $20 is reasonable because we'd have to actually, do that to save the entire U.S. stock market, okay? Our one little tiny wildcatting firm out in West Texas, if the price went too high, it could imperil the U.S. stock market. That's what some people are saying. But let's see what that really means. So if $20 per share is what it would take to save the U.S. stock market, let's see. So the amount of money that could endanger the U.S. stock market, that would be, reasonable damage or limits for shorts. Let's say that's $1.8 trillion. If we take the total amount of money that's available to bail out the stock market and we divide that by the dollars per share, we can find an implied number of shares that were actually shorted, right? It's very simple math. Okay, we take the total dollar value of the money that's available to bail out the U.S. stock market. Let's just say it's the DTCC's $1.8 trillion. We divide that by $20. And we get the number of shares, the implied number of shares that were shorted. What do you think we get? Wow, we get 90 billion shares that were shorted. 90 billion shares. Do you think that 90 billion shares of MMTLP were shorted? Well, I don't know. But I somehow don't think that 90 billion shares were shorted. But let's say 90 billion shares were shorted. What does that mean? We know that there were only 165 million shares issued. That means that shorts shorted 544 times the number of shares that were actually issued, right? Wow, 544 times the number of shares that were actually issued. So let's put this into a nice grid so we can see what's going on. And don't forget we can see the implied number of shares that were shorted by just taking the total dollar value that it would take to bail out, the U.S. that would bail out the U.S. stock market to prevent harm, and divide that by the dollars per share, right? It's very, very simple, right? So maybe $100. What about $100? If $100 is, what you have to accept as being reasonable in order to prevent the U.S. stock market from imploding because, we're asking too much money, what does that mean? Well, again, let's just say that there's $1.8 trillion. There could be more. But let's just say that there's $1.8 trillion that's available to bail out the U.S. stock market, and we would use it all up because we were asking too much money. That means that the implied number of shares is 18 billion shares. That means that 109 times the number of shares that were issued, 165 million shares, 109 times the number of shares that were actually issued was shorted. Do I think that's the case? I don't know. That's probably what the people who are saying that, you got to accept $20 per share. You got to accept $100 per share. They're saying that this stock was shorted 109 to 1. 109 shares were shorted for every single share that was issued. That's what they're saying. I don't necessarily believe that. Okay, let's say that it's reasonable to accept $500 per share. If it's reasonable to accept $500 per share and there's $1.8 trillion that's available to bail out the U.S., stock market, that implies that there's 3.6 billion shares. Oh, man, 3.6 billion shares. Is it possible? I don't know. I think that's a high number. But that's implying that 22 shares were shorted for every share that was issued. Again, 22 shares were shorted for every single share that was issued based upon $500 per share. What about $1,000 per share? That means 11 shares were shorted for every share that was issued. What about $4,000 per share? $4,000 per share. If there's $1.8 trillion available, that means that there's about 450 million shares that were shorted. That's kind of getting to the ballpark number, I think, right? That means that there's about 3 shares that were shorted, naked shorted, for every single share that was issued. Let's say the price even went up to $6,000. What happens if it got to $6,000 per share and there was $1.8 trillion available? That implies that there was 300 million short shares, or about 2 shares were shorted for every share that exists. 2 shares that were shorted for every share that exists, okay? So, again, what does it mean when people are saying that you got to be reasonable, you got to accept $20 per share, because anything more than that, it's going to harm the U.S. stock market in general, and it's going to collapse the entire U.S. economy. What they're saying is, let's just say that there was $1.8 trillion available to deal with problems in the U.S. stock market. They're saying that there were 90 billion shares of MMTLP that was shorted. That's the implication, okay? We'll accept $20 per share if they will come clean and say that there were 90 billion shares of MMTLP that were shorted, which means that there were 544 shares were shorted for every share that was actually issued. Do I think that's the case? I don't know. I don't really think that's the case. I think that there might have been 2 to 3 shares that were shorted for every share that was issued. Still a very big number, but that's somewhere in the range of $4,000 to $5,000, assuming that there's $1.8 trillion available to deal with situations like this, that the DTCC has to deal with situations like this. So anyone tells you that there's not enough money, that you got to accept $20 per share, tell them back, you know what that means. That means that there were 90 billion shares shorted of MMTLP. 90 billion shares. Because that's $20 times 90 billion, that works out to $1.8 trillion. That's the amount of money that would harm the U.S. financial markets. That's the amount of money that the DTCC would have to backstop. And I don't know. Do we think that the DTC can't backstop a major problem? Is that what you're saying? Are you saying that that this little wildcatting firm accounted for more than 0.0001% of any one of these short hedge funds, entire portfolio? Or are you saying that the shorting of MMTLP accounted for 10% of the portfolio, 1% of the portfolio? What are you saying? Huh? So anyway, that's just my thoughts on this. Just doing some math. Anyone can do the math. I showed you the math. You can do it yourself. Feel free to double check my math. Okay? Please. Tell me if I'm wrong about that. Anyway, that's just me talking about MMTLP, reasonable price limits. I am not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. Thank you. Goodbye.